Hi guys, and welcome to this very special edition of Money Control Markets Weekly. I'm Karunya Rao, and we're back once again to talk about the key movements and the key stocks and developments and market updates that transpired in the week gone by. And what is it that you must watch out for the times to come? Joining me today in conversation is Mr. Gautam Duggad from Motilal Oswal. Thank you so much for taking time out, Gautam.
Thank you.
Well, first things first, I'd like to understand your assessment of the market. What is exactly happening? Because it doesn't seem to have enough triggers to breach that important and psychologically critical level of 16,000. Can you tell us what is it that the market is that could perhaps finally push the market beyond that level?
Good afternoon, Karunya. Actually, see, the way markets have rallied in the last 12 or 15 months, it is not unsurprising that there is some amount of consolidation which is happening because we moved very fast from 10,000 to 16,000. It is important that earnings are, allowed to catch up with the markets, right? We have seen a very good earnings performance in FY21. We ended with a 15% earnings growth in Nifty for FY21, which is, by the way, the best in a decade. The last 10 years, our average earnings CAGR has been about 6%. So the best earnings growth came in a year in which we have seen the maximum disruption. Economies were locked down and there was so much, pain, which all of us have gone through. But even in an environment like that, corporate earnings stood very resilient. And now we're expecting FY22 to also begin with a bang. And as we are talking in the midst of an earnings season, so far about 50% of the Nifty companies have reported their earnings, and the earnings are going exactly as per expectations so far. So it is good that market is catching up its breath. There is a consolidation which is happening, and earnings are also trying to catch up with the market reality. The supportive backdrop on global liquidity and interest rates being so benign has obviously helped the markets to run ahead of the fundamentals for some time. But as we have witnessed and evidenced so often in the past, market beyond a point cannot run without earnings. If you see a very long period of performance of the market, then the decade between FY10 to 20 Nifty earnings have compounded at about 6.5%, and markets have also grown at about 8.5%. So while there is a short period of time always where markets and earnings get disjointed, but over a long period of time they converge. And therefore, it is not very worrying that market is taking its own sweet time to cross whatever barrier that you mentioned. What is important is the earnings delivery keeps happening, and corporate India keeps meeting the expectations on the P&L and balance sheet. So there is no concern so far out there unless we run into a third wave or a fourth wave of COVID-19, which none of us can predict. But I won't worry too much about where markets are right now as long as earnings keep coming.
So let's talk earnings then. Tell us anything that really stood out for you. Of course, you just mentioned that earnings have been quite impressive so far. But anything that specifically you would like to highlight for our viewers?
Sure. So, Karunya, we were expecting about 70% plus earnings growth so far for the companies which have reported. And we've got about 70% exactly in the Nifty. So when you look top down for the 26 companies in the Nifty 50 basket, which have reported their earnings so far, the numbers are bang in line with expectations. Now, within the aggregate, there are obviously some sectors which have outperformed, some which have underperformed. What stood out for me is IT, where not only have they met expectations, but the commentary from management across the companies in IT, whether it is a large cap or a mid cap, has been very solid. So underlying digital transformation that we've been witnessing post COVID-19, that continues to remain very resilient. And management commentaries do suggest that this is one area where next 2 or 3 years, the IT spending can continue to surprise people. So they've delivered very strong set of numbers, commentary on demand, order book, the demand pipeline, and sizes of the deals. They all look very strong, and given the way they've been hiring left, right, and center, and at the same time you're also seeing utilization going up, trend of offshoring picking up, and at the margin you're seeing a much higher attrition level than what we've been used to in the last 3-4 years. All of this point towards a very strong demand scenario, and therefore I think this is one sector which is looking very strong. We are big overweight on IT in our model portfolio, about 350 basis point overweight. The other sector which has been the star performer over the last 2 or 3 quarters, and that continues even in this quarter, is metals. So metals earnings are literally, blockbuster, you can say, for last 2 quarters and this quarter as well. And then cement has also done well. So these are the three sectors which stood out on the positive side.
We'd like to also understand IT. Of course, you remain bullish, long-term prospects are intact. But given the way most of these stocks have run up, what about valuations? Can you advise our investors whether they should still go ahead and buy at these levels, or should they wait for a bit, perhaps for some kind of market gyrations?
So Karanya, basically in markets, one thing that we have all learned is it is very difficult to time, right? And as long as earnings are coming through, I think valuations will not correct a whole lot. In fact, the market itself is not cheap. If you look at the current P multiple of market, it is trading somewhere around 22 to 22 and a half times, which is not cheap by any stretch of imagination. So therefore, sector like IT, which throws 100% plus free cash flow conversion, has a 80 to 90% of free cash flow returned back as dividend or buyback. I don't see it will correct in a hurry as far as valuations are concerned, given the underlying very strong demand commentary. Obviously, there can be some stocks which might catch up, which would have run up a whole lot in the last 12-18 months. Names like Coforge, Happiest Mind, they've all had a very strong performance. So there can be some time correction here and there that one can never rule out. But as a whole, we continue to like this space. Our preference is Infosys, SCL Tech in the large cap domain, and we like Emphasis, we like L&T Technology, and Cyient in the mid cap basket.
Okay. Moving on to the metal space as well, since you touched upon that, it of course was pretty much in the limelight this week once again. There was some news coming in as well that China has increased steel prices, which is expected to benefit Indian steel companies. And of course, what followed after in terms of stock prices is something that we all are aware of. Talk to us about picking stocks within the metal space. Is this the right time?
See, it is very tough to predict short-term moves in sectors like metal because they're global cyclical sector. The entry and exit price is very important. This is not a secular structural sector like consumer or IT or a private financial. Here, the entry and exit point matters a lot, and the sector is dependent on global news flow and what is happening to global commodity prices. And we have all seen metal stocks have gone up 3x to 4x in the last 12 to 15 months. So obviously, whoever is entering now at this price, the risk reward obviously is not as lucrative as it used to be, say, 12 months or even 6 months back. What is favorable for metal sector right now is the continued strong underlying commodity prices and overall spending in infra that we are witnessing not just in India but globally. So that is supportive of the commodity prices. And at the margin, you have seen a very strong deleveraging play out in the last 12 months in metals. Whether it is Tata Steel or Hindalco or JSPL or JSW Steel or even SAIL for that matter, all of them have reduced the debt significantly in the balance sheet over the last 12 months. Now, what is important is what is the price factoring in? As of now, when we look at our assumptions in the models are about at a 5 to 10% discount to spot prices. And therefore, there remains a room for upgrades in our earnings estimates as far as metals is concerned if the prevailing commodity prices do not correct significantly. Having said that, the prices are not as lucrative as they used to be 6 or 12 months back. So one has to be extremely cautious when selecting a metal stock. We have preference for Hindalco and SAIL in our model portfolio, which are our top ideas.
I just want to nudge you back towards IT because some of our viewer questions have also started trickling in. A viewer is asking how China tech stocks sell-off affect the Indian markets. Can you explain the whole phenomena? Because this was, of course, something that was causing some amount of jitteriness among investors in the week gone by.
Sure. No, we've all seen how in the last 45 days, the events which have happened in China, particularly in the technology sector, and the recent developments around their announcements on edtech sector, they have not pleased the investors at all. And we have seen huge corrections in the benchmark stocks there belonging to the technology sector. But can we extrapolate that for India? I would think the answer is no. We are in a very different stage of market evolution as far as technology sector is concerned. We have seen just the first big startup listing which has happened. So for us, the journey is just beginning. And historically also, we have seen that regulatory actions have tend to be very volatile in markets like China, which fortunately has not been the case in India. So while I will keep an eye on what is happening around the world, I will not get deterred by that. And it is important that we remain focused on India and understand and evaluate the stocks in the context of what is happening in India, rather than get swayed or carried away by the global developments. So for me, in India, the journey as far as technology and consumer internet sector is concerned, it is just begun.
Okay, all right. This week another very predominant sector was the pharmaceutical industry, the Nifty Pharma Index. You had Dr. Reddy falling almost 15% in a span of 2-3 sessions. Sun Pharma, on the other hand, was up 10% today itself, given the earnings performance, of course, and the enthusiasm that followed. There was a crazy amount of volatility seen in this basket. Can you share your insights on the pharma space, how to play this theme at the current juncture?
So, Karna, one interesting thing about pharma sector is it is a very stock individual bottoms-up driven sector. There is no uniform sector-related operational matrices which apply in pharma, like it applies in cement or a banking or even in IT for that matter.
Yeah.
In pharma, each stock has its own, dynamics, and therefore I won't extrapolate again from what is happening in Reddy to Sun Pharma or what is happening in Sun to Cipla. You have to evaluate bottoms up each stock and then decide where you are in the earning cycle. The interesting thing in pharma is after 5 years of stagnation, the earnings have grown first time in FY21. So the profit pool of Motilal Oswal Pharma Universe was 20,000 crores in FY15. It remained at 20,000 crores even in FY20. And FY21 is the first year where we saw a big 45% growth. And now we are expecting in FY22 for the growth to normalize. Obviously, FY21 benefited from multiple one-off things. The big push from the COVID-19, the huge boost that API got in last year, maybe that is not sustainable. So the normal trajectory of earnings would be 14-15%, which is what we are building in for FY22. And what we like here is very niche specific stories where the pricing power is not threatened, where the regulatory compliance related credentials are very well established, and the prices still offer a decent room for long-term compounding. So we like Divi's Laboratories, we like Gland Pharma. Both of these stocks are part of our model portfolio. And in the mid-small cap space, we like Ipca and Solera Pharma.
Okay, all right. We often get queries and questions from our viewers on an upcoming correction or a market, or the fact that the market valuation is quite high. Do you think there is something our retail investors should be keeping in mind while buying over the next few weeks?
Yeah, I mean, I completely agree. Valuations are not, giving you a sense of a lot of comfort in the short term at least. But at the same time, we are seeing earning cycle changing after 10 years of going nowhere. So, I think this is a scenario which is reminiscent of 2003-4, where after multiple years of very muted earnings performance, corporate India's earnings started growing from 2004 onwards. If you had sold stocks after first year of strong earnings, then you would have missed on the upside subsequent 3 years from 2005 to 8. So I don't want to go and indiscriminately sell. However, I want to make sure that the stocks which are there in my portfolio are justifying their presence fundamentally. They're not there based on just story or narratives. They should be there based on their underlying fundamentals, earnings, cash flows, and free cash flow as well. So that is one thing that I will cross check continuously as market keeps moving up. The other element on which we have written recently, a couple of weeks back, is on the mid cap space, where if you compare cross cycle valuation, across periods from 2005 to 2020, the recent 12-month sharp outperformance of mid cap and small cap indices, they seem to suggest that there is a room for large caps to outperform from here. So there are of course some pockets in mid cap, small cap indices where there is where the prices are not being justified by the underlying fundamentals. So therefore, I will tend to be extra cautious in mid cap. But yeah, I mean, I don't want to go and sell indiscriminately at this stage of the earnings upcycle. There is a lot more to come on corporate India's earnings. We just had one good year of earnings. In between, you will keep getting intermittent corrections, which are the part and parcel of the bull market.
Well said. If we look at the overall trends in the market, we've seen rallies in almost every sector last few weeks, whether it's mid cap or large cap IT, textiles, real estate, metals, of course, have been quite resilient. Perhaps the only sector which is still a bit sluggish is auto. Do you have, any insights or any preferences within the auto basket, whether it's OEM, ancillary, tire space? Because yes, right now the earnings visibility perhaps could be a bit muted or a bit under scrutiny because of raw material costs, because of weak demand, etc. But overall, over the next 2-3 years, how do you see auto play out, and who within this basket could be key beneficiaries?
So in auto, our view for a long time has been that this is one sector which is most vulnerable to earnings downgrade, because you are coming out of a very terrible second COVID wave where the damage to consumer sentiment has been massive. And this is a high ticket discretionary item which can always see some pushback and deferment of purchases. On top of that, as you rightly mentioned, there is a headwind of higher commodity prices as well as a lack of operating leverage. So all these three factors put together are putting a lot of pressure on auto earnings. In fact, even in this quarter, from the companies which have reported earnings so far, by and large, we have seen disappointment, whether it was Tata Motors or Maruti or even Bajaj Auto for that matter. So I continue to have that view that auto is one sector where the risk to earnings estimate is the highest in our coverage universe. What we like relatively within auto is M&M, and we also have a preference as far as global play is concerned towards Motherson Subi. And within auto tanks or auto components, we prefer endurance. But top down, we have a neutralish view on auto. We are more biased towards sectors like IT, financials, where we have a 300 to 350 basis point overweight. And then we like metal, cement, and consumer. We have a neutralish stance on auto and pharma.
Okay. Any other sectors perhaps that our viewers should be on a lookout on? Because, like I said, majority of them have seen a very phenomenal run up already. Any other sectors perhaps which could be an underdog and has good potential even at current levels to see further, whether it's earnings growth or stock returns, either or?
I'm very positive on financials. It has not participated the last 8 or 9 months. Bank Nifty has underperformed. But I think if I have to one sector as a play on opening up trade, then I think financials is the best one, especially the large cap financials, where the performance has not been damaged materially by the second wave of COVID. Of course, there has been some disappointments here and there, but by and large, they've met expectations. Even FY21, the growth in financials earnings was quite strong. So Nifty financials earnings, if I have to take you back to FY18, where they bottomed out at 44,000 crores, from there in FY21, they delivered 1,12,000 crores of earnings. Next year, we're expecting 1,54,000 crores, and subsequent to that, we're expecting 1,95,000 crores in FY23. So, and there has been a time correction in good high quality stocks like HDFC Bank, Kotak Bank, which I would, not rule out as something where I will have an eye on. Aside of that, we continue to like ICICI, Axis, and SBI. This is the sector which we prefer. While it has not performed as well as the markets have done in the last 6 months, but it continues to offer very strong return potential from current prices. And the other sector which remains a perennial, long-term bullish undertone is consumer, because this is a very
Okay.
long-term story. While valuations obviously are expensive, they've always been expensive. So if you have a genuine 3, 5, 10-year kind of a view, then you should not hesitate from investing in this sector. There are a lot of good companies there with a very strong proven track record and great financial matrices over the last 5, 10 years. And they've compounded very well in the past. And I have no doubt that they will continue to compound well. However, this is not a sector for those who have a very short-term outlook of 3 months, 6 months. This sector needs a genuine 3 to 5 year kind of an outlook for making good compounding money. We like Hindustan Lever there, Titan, Pidilite, Tata Consumer, Jubilant Foodworks, and Britannia. So those are 5 or 6 stocks which we like in consumer. But again, I mean, at the cost of repeating myself, more as a long-term play rather than short-term flip-flop on trading.
Okay. What about the unlocked trade candidates? Just about a month back or so, there was a lot of focus on QSR, hotels, airlines, etc. When there was, high expectations of an outrush of demand, when things would reopen once again, when different states would start unlocking. What is your view there? Any stocks or any themes you like within that?
So in unlock, as I said, I find financials are the best play on unlock trade,
Okay.
because if economy opens up, then disbursements will pick up, asset quality will improve, and these are the two most tracked matrices in financials. And if they tend to get better from here, then obviously financials will reflect that performance. Aside of that, the usual names that everyone is aware about, multiplex and hotels, and maybe aviation, though I don't know, I mean, the kind of losses that aviation companies are reporting, when that will come back into the black is something which nobody can predict. But relatively, I will prefer financials and then retail as an unlocked trade. So within retail, we like Trent, we like Titan, ABFRL. So those are some of the names which I think will benefit from the unlocked trade. But the biggest one is financials.
Okay. All right. Just also want to understand your view on QSRs. Devyani International's IPO will be opening for subscription next week. So, do you expect to see any rub-off effect, perhaps, on the existing listed entities in the space?
I can't comment specifically on Devyani because we are bankers, so
Okay.
I won't be able to comment there. But in general, QSR space looks very strong to us from a long-term point of view. We've recently upgraded Jubilant Foodworks. It's a different matter that these days, whatever target prices you put, 1 year target prices come in 10 days or 15 days. That's the kind of markets we are living in. We've also covered Burger King. We like Westlife as well. So I think this entire QSR space in India has many legs to run, and the story has just begun. Given the underpenetration that exists, the frequency of ordering, the frequency of dining out, any metric you take, we are way behind. Countries even in Asia Pac, forget the developed world. So the room for growth in this space is humongous. And with growth comes the operating leverage and therefore the earnings growth. So I have no doubt that these companies will continue to make money while they will keep looking expensive. I mean, when Jubilant Foodworks IPO came in Feb 2010, even the IPO price was supposed to be very expensive. And since then, that stock has multiplied 32 times and it is still expensive. So that tells you the story, because sometimes we keep looking at forward projections, but it is once in a while good to take a look back and see how things have panned out over the last 10, 15 years in some of these categories. So yeah, I mean, to cut the story short, we are positive on QSR and we like many stocks in that space.
Keeping it with some of our viewer queries trickling in, we have one question coming in from our Facebook that we're live streaming as well right now. Your view on power sector, all of these stocks have done phenomenally well if we see the last 4 5 months trajectory, and some of them include the likes of PSUs as well, like NTPC and a Power Grid. Where do you stand when it comes to this particular sector?
We don't like that sector much actually. We have almost zero weightage to utilities. We think that that sector, especially the ones which are dependent on thermal power, are running into the ESG wall. And therefore, while they keep looking cheap, they've been cheap for last 10 or 12 years and have not generated any investor returns. The only thing that goes in their favor is the valuations, which are trading at one time price to book or even sub one time price to book. But besides that, it is very difficult to figure out, the long-term trajectory of returns. So we tend to stay away from that space. We prefer relatively niche, stocks in that segment. So something like an IEX is what has enthused us. We had covered it about 8 months back, added it in our model portfolio, and now the stock has more than doubled in the space of last 7 8 months. So we now taken it out because now the valuations are not as lucrative as they were when we started covering. But yeah, I mean, if you're asking about the big names in that domain, they are not something where we are too positive on.
All right. Just to wrap up this conversation, Gautam, I'd like to understand once again, next week is going to be extremely earnings heavy. Any candidates or any specific names you will be watching out for specifically?
I think SBI is an interesting stock which is yet to report. Then Tata Steel, because that will set the stone for the remaining metals companies. These are two
Yeah.
stocks which will also decide the aggregate performance of Nifty as well. Right. So those are two
Right.
big heavy names where I think market will be very keenly watching their earnings.
Of course, you've shared your view on financials with us, but specifically for SBI, do you have a view there?
Yes, we are positive on it. In fact, it is the highest weighted stock in our model portfolio. We think that the way subsidiaries are also performing, the current market price offers too much of a value. And see the way this space has played out in the last 10 or 12 years. If I give you one number, between FY10 to 20 put together, SBI delivered a pre-provisioning operating profit of 5.3 lakh crore and HDFC Bank delivered 2.3 lakh crore. So HDFC Bank's PPOP was just 40% of SBI's PPOP for the decade, but 60% of the operating profits of SBI went into provisions, and just 10% of HDFC Bank's pre-provisioning operating profit went into provisions. So that tells you the way cycle has played out in FY10 to 20. So while HDFC Bank was just 40% of PPOP, its profit after tax was 150% of SBI's profit after tax for the decade. We are expecting that to reverse now. In fact, our projection suggests that SBI's profits in FY23 will converge with HDFC Bank's profit after a long, long time. In fact, after 12 years. And therefore, that makes us more bullish on the erstwhile corporate financials like SBI, ICICI, and Axis. And we have a big overweight on SBI in our model portfolio.
Okay, so let's say if you were to invest, say, a corpus of 5 lakh rupees at the current level in the market as it stands, which themes or sectors will you distribute them across?
So bulk of that will go into financials, consumer, and IT, and then into metals, cement, and then some part in auto and pharma, and very selective in mid cap, small caps. Right. So if I give you the composition and color of our model portfolio, that will broadly, represent what I am talking about. So 37-38% of our model portfolio is into financials, 17-18% is into IT, 13% is in consumer. So that makes it almost 67-68%. And then we have 4% in metals, 4% in cement, 5% in auto, 4% in pharma, and then we have about 7-8% in mid caps. We have no weightage to telecom, we have no weightage to real estate, we have no weightage to infrastructure, and no weightage to utilities or oil and gas.
Okay, on that note, Gautam, we'll let you go. Thank you so much for joining us and for sharing your insights across the different key stocks and sectors that have been in focus. And thank you once again for taking time out.
Thank you. Thank you.